I'm Elizabeth Warren, Chair of the Congressional Oversight Panel. I'm here to introduce our August report on the continued risk of troubled assets. Last fall, as the housing market fell into turmoil, many borrowers were unable to make their monthly mortgage payments. Banks and investors holding these mortgages faced a crisis. If borrowers failed to repay, then the loans would be worth a lot less, and the banks would risk collapse. These bad mortgages and the securities that were based on them became known as toxic or troubled assets. The Secretary of the Treasury at the time, Henry Paulson, argued for a huge program to buy up hundreds of billions of dollars in toxic assets to restore stability to the financial system. But by the time the Troubled Asset Relief Program, or TARP, was signed into law a few weeks later, the Secretary had settled on a different strategy. He provided TARP money directly into the banks in exchange for stock and warrants. Now let's be clear, Treasury's direct capital investments help stabilize many banks, particularly the big ones, and some of them use this as a chance to write down some of their bad debts. But no matter how you slice it, an overwhelming portion of the troubled assets from last October likely remains on the bank balance sheets today. One of the biggest challenges of toxic assets is how to account for them. This is important because the valuation determines whether the banks have money to lend and even whether they have adequate assets to survive. Now, in ordinary times, banks valued mortgage-backed assets by marking to market. If one of these securities were, for example, selling for $100 on the open market, then it appeared on the balance sheet of the bank as a $100 asset. When the magnitude of the mortgages in default started coming to light last fall, the market seized up. No one was willing to pay the price that the banks wanted for these mortgages. A mark-to-market would cause a huge drop in the value of the assets, with the consequence that the bank's assets would shrink and the banks would need to raise even more capital or be forced to close. To address the problem, the banks were allowed to book many of their assets at a modeled price that was generally higher than the market price. The rule changes helped the banks stay afloat and meet capital requirements, even while the same troubled assets remained on their books. So that's where we are today. Banks continue to hold trillions of dollars in toxic assets. As long as they do not sell these mortgages or write them down on their books, they don't have to recognize any losses on them. But that won't change the underlying reality. If the economy worsens, especially if unemployment remains elevated, or if the commercial real estate market gets into real trouble, then mortgage defaults will keep going up, and banks will incur further losses on their troubled assets. The financial system will remain vulnerable to precisely the kind of crisis that TARP was meant to fix. Now, Treasury is launching a program to try to restart a market for troubled assets by enticing buyers to bid for them. It's called the Public-Private Investment Program, or PPIP. It isn't clear whether the program will effectively remove toxic assets from the bank balance sheets or not. The problem with PPIP is straightforward. If the sale price is still too much lower than the book price for these toxic assets, then the banks could still face collapse. They could be required to raise more capital, to ask for more government assistance, or to close their doors. So banks may choose to stay out of PPIP, preferring to carry toxic assets at higher valuations rather than selling them at lower prices. An especially worrisome part of the troubled asset problem is its impact on small banks. Small banks tend to hold whole mortgages rather than the securitized packages of mortgages that are held by the big banks. But the current PPIP program does not include whole mortgages. It's limited to securitized loans. Small banks face another problem. they hold more commercial real estate loans, which pose a threat of high defaults when they begin to mature in the near future. Because small banks have more difficulty raising capital, they could face a real squeeze. Remember, too, that the smaller banks have not been evaluated under the stress test to see if they have adequate capital set aside for their mortgage losses. As Treasury goes forward with PPIP, we have two suggestions. First, if the economic indicators are worse than those used in the recent stress tests, the Oversight Panel recommends that stress tests be repeated. We also think they should be applied, perhaps in modified form, to smaller banks. The stress tests are our best tool to gauge risks and the bank's ability to survive additional losses. Second, Treasury should move toward greater disclosure of the terms and volume of troubled assets still on the bank's books. Last fall showed us that toxic assets carry great risk for the entire financial system. We need to know the size of that risk so that we can determine the adequacy of our response. You can read the full report and offer your thoughts by visiting our website, cop.senate.gov. That's cop.senate.gov. This crisis was years in the making, and it won't be solved overnight. But we're now 10 months into TARP, and troubled assets remain a serious danger. Treasury took aggressive action to recapitalize the banks, and these steps have provided substantial protection for large banks and for the banking system. But so long as the underlying problem of troubled assets remains unresolved, our long-term financial stability remains at risk.